If interest rates are low, then refinancing your home mortgage loan might be an attractive option if you are looking to pay smaller payments or to save a significantly large amount of money. If you are considering refinancing, then it is really important for you to understand whether or not it is the right time to refinance, whether the costs associated with refinancing, as well as what are the available options when it comes to refinancing to make sure that you are making the right choice for your future. Hi, Vincent Chan here from The Simple Dollar, and today we are talking about whether it is the right time for you to refinance your home while interest rates are low. And if that sounds good to you, make sure you smash the subscribe button and ring the notification bell to always get the latest and greatest from The Simple Dollar. Firstly, what exactly is refinancing? Well, simply put, refinancing means you're replacing your existing loan with a new loan with different terms. In essence, you are pretty much just borrowing money in order to pay off your old loan and accepting the new terms with the new loan. There are a ton of different reasons to actually refinance a loan. One is to decrease the interest rates to actually start saving more money. Number two is to start lowering your payments. And number three is to enter a new loan with more favorable terms. And there's a ton of other reasons as well. When it comes to refinancing mortgage, there are a ton of unique options out there for homeowners. Some of the more popular ones are rate and term refinances, short refinances, as well as cash refinances. And each of these unique refinancing options can be further customized to fit your personal needs. Rate and term refinances is probably the most popular option in order to get more favorable rates and terms. This refinancing option is really good for people who has a major change in their financial picture or will have a major change. For example, if your credit score has significantly improved or the interest rates have significantly dropped. Another really popular refinancing option is to shift your loan into an adjustable rate mortgage. These loans typically start off with a lower rate of interest, at least for a fixed introductory period of time. However, eventually they do shift off into following an associated interest rate index. These loans are a good option for people who are planning to sell the home before the introductory fixed rate is over, or if they believe that the interest rate is going to drop in the future. Short refinances act as a lifeline for those who may not be in a good financial situation and are at risk of losing their homes. No one plans to end up in this negative financial situation, but if you do end up in this situation, just know that there are some refinancing options to help you through. Now, the right time to actually refinance your mortgage really depends on the type of refinancing that you want to do. However, life and market conditions might dictate what is your opportune time. Another example is if you were looking for a rate and term refinance, then of course your credit score or the interest rate is going to help dictate that. Refinancing in a seller favorable market could be the right move instead of selling. Currently, the housing market is considered to be more leveraged for the seller, which is in contrast to the post-2008 market collapse. During that time, rates were still low and sellers lost a ton of equity with their homes. Today, however, with sellers regaining their leverage and equity, still need to take heed of low rates. Many sellers, upon actually selling their home, immediately becomes buyers, and once they're a buyer, they're actually purchasing with less leverage. It makes a lot of sense for buyers to actually refinance their homes instead of selling because it could be very, very costly to buy a new home in a seller's market. Now, it's easy to only look at market conditions and interest rates when it comes to deciding whether or not you should refinance your mortgage. However, the problem with this is that there are a lot of costs that need to be taken into account when determining whether or not refinancing is a good option for you. For example, when you secure a new loan, you're gonna have to pay for closing costs again. While this may not be an immediate deal breaker, it is good to take this into account and measure it against the amount of money you're actually gonna be saving from a lower interest rate and see whether or not that makes sense in the end. It's also important to avoid tunnel vision, which may be caused from lower payments, and you wanna take into account the long-term cost because you might end up paying more in interest. Refinancing at a lower rate might seem attractive, but it really doesn't erase any of the debt you actually owe. You want to make sure you're not tacking on extensive additional interest payments unless it is absolutely necessary. You'll also want to compare the pros and cons with your current loan against your new potential loan. Take the time to read the fine print of this new loan to make sure that it is right for you, not only right now, but also long-term in the future. Interest rates have been steadily dropping over the past year, which makes refinancing your mortgage seem like an attractive option. These lower rates could mean significant savings when it comes to not only new, but also refinance loans. In conclusion, if you're interested in refinancing, make sure you check out all all the available refinancing options. Make sure you calculate the potential cost and savings involved, as well as weigh out the pros and cons. As always, thank you so much for watching. If you have any questions about this topic, feel free to leave a comment down below and we'll get back to you as quickly as possible. And remember, if you enjoyed this video, make sure to smash that subscribe button to always get the latest and greatest from the Simple Dollar. And remember, you can find this content and loads more by visiting thesimpledollar.com.